Hey guys, my name is Gareth and welcome back to my Finance Fitness YouTube channel. Debt often has a negative connotation. So in today's video, we're going to look at the good, the bad and the ugly of debt. First off, what is debt? Well, debt is just when somebody goes out and borrows money from somebody else. And for most of us, these will be things like a mortgage on our home, a personal loan to buy a car, student loan debts, credit cards, bank overdrafts. And it's not just people that use debts. Companies use debts all the time as a source of funding. But in fact, the biggest user of debt is governments. Governments and companies access debt by issuing bonds. And a bond is just a promise to repay in the future. These bonds are issued in the financial markets. Fun fact, now while many of us are familiar with stock markets, the bond market is actually much bigger than the stock market, with daily trading volumes 3.5 times that of the stock market. So now that we're clear on what debt is, let's look at the good, the bad and the ugly. First off, I just want to point out that you can hit the like and subscribe buttons on this video without using any debt. Jokes aside guys, the more activity there is on a video, whether it's likes, comments, subscriptions and shares, the more the YouTube algorithm will promote that video and help it grow. So your support really makes a big difference. So let's get into it. Number one is that it helps you get access to goods and services. Debt is an instant source of cash. And it enables you to go out and buy the things that you want instead of having to wait until you have enough money to go buy it with cash. And of course, as people are able to go out and buy things sooner, this has a positive impact on the economy. So let's look at a real estate example. When it comes to real estate, the numbers can be quite big. And while many of us may have enough cash to go out and buy a shirt, it's not the same when it comes to real estate investments. Most of us will probably need to get a mortgage or a loan. And even if you had enough money to buy a property for cash, it might not be the best investment decision. So let's say you have $100,000 in the bank and you want to invest this in real estate. Let's assume that $100,000 is enough to buy a property in your area. I know some areas are cheaper and some are more expensive. So in scenario one, you take your $100,000 and you buy a property for cash. So you have a total property of $100,000 and zero in mortgages, so your net investment is $100,000. Now in scenario 2, we take that $100,000 but we split it between two properties, with each receiving a $50,000 down payment or deposit and the remaining $50,000 for each being borrowed through a mortgage or a loan. In this case, you've got total properties of $200,000 and mortgages of $100,000. So again, as in scenario 1, your net investment is $100,000. Now let's assume that some time has passed and your properties have increased by 10%. In scenario 1, your $100,000 property is now worth $110,000. And since you have no mortgage on it, your net investment is also $110,000. But in scenario 2, each of your properties have increased by $10,000. So your total properties have gone from $200,000 to $220,000, but you still owe $100,000 in mortgages. This leaves you with a net investment of $120,000. So you've increased your investment by $20,000 compared to $10,000 in scenario 1. In fact, this difference could be even greater if you consider that scenario 2 would have received rental income from two properties. You would have been able to deduct your interest cost from your tax bill, and every month you would have paid down the capital amount owing on your mortgages. Now assume that you, instead of buying two properties, you went out and bought 4 properties. This would have increased your returns even more. And using debt in this way is often referred to as leverage. The more leverage you have, the more you're using debt to fund your purchases and investments. I will be doing some future videos on real estate investments, so make sure you subscribe to the channel to see those. The author of the book Rich Dad Poor Dad, which is one of the best-selling investment and real estate books around, Robert Kiyosaki, is often quoted as saying how much he loves debt And the reason for this is because he understands the power of leverage and how that can fast track your personal financial growth journey. This is one of the most fundamental books on investments and real estate, and I'd strongly recommend reading it. So if you're interested, I have included a link in the description. Now, using debt, whether it's in the form of credit cards or loans, also helps you build up your credit score because your monthly repayments are tracked. A credit score is really important when it comes to debt. The higher your credit score, the better, because the banks will perceive you as a lower risk client when they lend money to you. There are many factors that affect your credit score, including if you've recently applied for debt, if you've got large amounts outstanding, and if you're late with some of your repayments. The first time I tried to buy a property, I was earning very little, I had little to no money to put as a deposit or down payment, and I had no credit score, and the banks offered me the best interest rate of 11.45%. And even by South African standards, that's a very high interest rate. Fortunately, I managed to secure that property at a really good price. And so even with such a high interest rate, the rental income I was getting every month was more than enough to cover all of the monthly expenses like condo fees, levies, municipal taxes, as well as my mortgage repayments. So it was still worth it to proceed. And once I bought that property and started building my credit score up, all the interest rates on my future deals were much better. Number 2 is that it helps companies grow their businesses faster. Generally, when companies need funding, they turn to 2 sources. Number 1 is debt, and number 2 is their shareholders. Now, generally, the cost of debt is significantly less than the return an investor would expect if they provided the cash. Also, the interest cost is tax deductible for the company, and so the companies tend to prefer using debt as a source of funding. Number 3 is that it helps governments fund their budgets for things like education, healthcare, social security. Since governments around the world spend more every year than what they receive in taxes, they fill this gap by using debt. This way, they're able to implement their planned spending and social programs sooner to try and increase their impact. In the previous scenario, we looked at taking your $100,000 and spreading it across 2 properties. But let's say you went all out and you bought 10 different properties with a $10,000 down payment on each. In this scenario, you have 10 properties with a total portfolio of $1 million, and at the same time you've got 10 mortgages to the value of a total of $900,000. And that is a significant amount of debt, and enough to keep many people awake at night. Think about some of these possible scenarios. What if some of your tenants stop paying? Or what if interest rates increase significantly and your monthly mortgage costs increase? Or maybe the property values drop by 20%. In this case, all of a sudden your total properties are only worth $800,000 and you still have mortgages to the value of $900,000, leaving you with a negative $100,000. All of these factors are possible and can cause a lot of stress and financial instability. And that's why it's important to make sure you don't overextend yourself, and to make sure you always keep an emergency fund to tide you over periods of financial difficulty. At some point, the money has to be paid back with interest. American household debt stood at $13.21 trillion in 2018. And if you were to write that out as a number, it would look like this. And the amount of debt that governments have been accumulating has been at levels we've never seen before. The US government, for example, has $26.3 trillion of debt, and Japan has $10.5 trillion of debt, which is 240% of their annual GDP or total output economically of the whole country. And at some point in time, these debts will need to be paid back. Also, if you have a lot of debt and not a great credit score, the banks will charge you a higher interest rate, and this can tend to be a downward spiral. With a higher interest rate, your monthly repayments are higher and more difficult to meet, increasing the chances of you defaulting or being late on your payments. That will of course have a negative impact on your credit score, which will result in higher interest rates, and so the cycle continues. It's too easy. It is so easy these days to apply for credit card or store credit, getting access to money immediately and giving you the feeling that you can go out and spend it, even though you'll have to repay it at some point in the future. And it's made easy in this way because this is a very profitable business for banks to be in. Banks offer great incentives like payment holidays, interest-free periods, and bonus points because they know that in the longer term they stand to make a lot of money in interest income from credit cards. The average credit card interest rate in the US is over 17%, which is significantly higher to mortgage interest rates, which presently are less than 5%. And we've seen what happens when household debt, especially in the housing market, gets out of control. Leading up to the 2008 financial crisis, people were overpaying on properties, they had very poor credit score, they had little to no money down, and this all pushed property prices up significantly. And eventually, when they couldn't meet the monthly payments, the market came crashing down. Stock markets fell over 50%, and we saw a sharp increase in foreclosures in the housing market, and many people lost everything. And this is the ugly side of when debt gets out of control. Luckily, many countries have imposed measures since the past financial crisis to try and limit the amount of money that people can borrow and avoid a similar repeat of what happened back then. Some of these measures include larger down payments needed, better minimum credit scores, higher earnings from the borrower, and a more thorough verification of the financial data included in mortgage applications. During periods of financial stress, governments may step in and provide bailouts to big companies to avoid job losses. And while this may make sense, it could also provide an incentive for companies to accumulate more debt, run a leaner operation, which will have a smaller margin of safety or buffer. This may make them more profitable, but also more vulnerable to unexpected shocks. But they may do this knowing that governments will step in and bail them out anyway, and this may not incentivize them to be more prudent and responsible and managing their businesses in a more sustainable way. In the previous recession, many companies actually used the proceeds from the bailouts to buy back their own stock as opposed to funding their expansion and their operations. This mainly benefited the shareholders as opposed to the employees and the broader economy as it was intended, and became quite controversial. This time around, many governments have imposed much stricter limitations on how the bailout money can be used by companies. So, is all debt bad? Let me know your thoughts in the comment section. In my opinion, I don't think so. Debt can be an amazing tool to help you accelerate your personal financial growth, help businesses fund their expansions, and governments implement their social programs. But it needs to be done in a responsible way, because it can go too far and it can lead to a recurrence of the 2008 financial crisis. So the important question to ask is, what are you buying with the debt? If you're going to buy something that's going to generate a return that's going to be greater than the cost of that debt, then it is worth doing, like that real estate example we looked at earlier. But if you're going to be buying items that are going to decrease in value, like clothing or electronics, then it's maybe better to avoid using debt for these and rather wait until you have enough cash to buy it instead. And if you find yourself in a situation where you feel overwhelmed by debt from credit cards and loans and overdrafts, then I would always recommend first paying down the one with the highest interest rate, because this will save you the most money in the longer term. Also, look for any opportunity to cut back on your living expenses and pay off more on these bad debts. I recently did a video on lockdown saving tips, and maybe you can find some of those cost saving tips useful, and I've included a link in the description. Thanks again for all the support. Please keep sharing these videos with your family and friends. Thank you again, and I'll see you next time.